Amazon and Apple are two of the biggest companies in the world, boasting market capitalizations of 2.4 trillion and 3.3 trillion respectively. But which one is the better long-term investment for stock market investors buying these stocks today and holding for the longer term? That's the question I'll answer in this video by comparing these two tech giants across several important financial categories, including revenue growth, operating cash flow, and then looking at their valuations by sharing with you my proprietary discounted cash flow valuation models for Apple and Amazon, which predicts, or I shouldn't say predicts, forecasts the free cash flow I expect these companies will generate over the next decade and more, and calculates a fair value for these stocks based on those forecasted free cash flows. And then I'll look at valuations on a forward price to earnings ratio to come up with a comprehensive decision on which one I think makes a better investment today. So let's jump into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, let's start with the revenue growth over the previous decade. And they've both done an excellent job boosting revenue, and they are giants to be sure. Amazon, in the most recent trailing 12-month period, generated a whopping $670 billion in revenue. And that was up from $136 billion in 2016. So Amazon has nearly 5x'd its revenue over the previous 10 years, and that's coming from a base of 136 billion. Very few companies in the world have 5x their revenue over the previous decade, and fewer still have done it at this large scale. So kudos to Amazon for achieving this kind of boost in revenue. Meanwhile, Apple has nearly doubled its revenue from 215 billion in 2016 to 409 billion in the most recent trailing 12-month period. But since 2022, Apple has really struggled for growth. Its revenue has only expanded from 394 billion to 409 billion over the previous 3 years. In the most recent quarter, Apple generated a surprising double-digit increase in revenue, and that was better than the management team was expecting. And so that was a surprise to be sure. But Apple has been noticeably behind, especially in artificial intelligence. It's failed to benefit from this boom, and investors are a little bit curious, including myself, about how Apple will generate growth going forward, especially as the company's being hit with the tariff headwinds. Apple famously imports a large percentage of the products it manufactures, or it's outsourcing its manufacturing, especially to assemblers in China and in other parts of the world. So Apple will face a lot of the headwinds from tariffs. Amazon as well has a large percentage of its items that are sold on the platform or sourced from outside the United States, which will be impacted by tariffs. But Amazon also has a robust cloud services segment that generates most of the company's profitability. It also has robust subscription services and robust advertising business, all of which are not subject to tariffs. So those parts of its business will continue to thrive, especially in its position against the artificial intelligence growth drivers. So the next thing I wanted to compare these two giants on is the operating cash flow to sales ratios. And I see an interesting development here. Two things that I notice. First of all, the trend lines. Amazon's profitability metrics or cash flow to sales ratios are improving, while Apple's are getting worse. The second thing I notice is that Apple is ahead of Amazon. So let's start with Apple. Its operating cash flow to sales ratio is down to 27%. It was at 35% a decade earlier. Meanwhile, Amazon's OCF to sales ratio has improved from 11% to 18% in the previous decade. They've both generated better growth in more profitable segments, Apple has generated better growth in its services segment, which has better cash flows, which has better margins. And Amazon has generated better growth from its cloud services segment, its advertising segment, which also has better margins. But Amazon has also significantly improved the profitability and cash flow ratios in its less profitable segments, the e-commerce business, due to economies and scale. It's reached such a large scale that it's been able to lower its cost to serve customers meaningfully, because if it's already visiting your street to deliver your products and it adds an incremental customer from your neighborhood, then it doesn't cost the company all that much more to deliver a product to your neighbor when it's already delivering a product to you. And so that scale advantage is really starting to pay off for Amazon as it's reached this large, approaching $700 billion in annualized revenue. So now that we looked at critically important metrics, let's look at valuation. And what I'm sharing with you here is my proprietary discounted cash flow model, where I forecast the present value of all of the free cash flow I expect Apple will generate between today and the very long run to be over $2.8 trillion discounted. That's the present value. So this company is a cash flow generating machine. It generated $109 billion in free cash flow in 2024. I'm forecasting that increases to 123 billion in 2025 and continues riding higher and higher going forward. I mentioned that Apple famously outsources its manufacturing, and that allows the company to generate lucrative cash flow from operations because it's paying only when the company is ordering products to be assembled and manufactured. So when sales go down, it doesn't spend money on those products to manufacture because it's not forecasting sales. It also doesn't require large capital investments in those manufacturing facilities. And so that allows the company to generate very strong cash flows from operations and a relatively low discount rate at 10.6%. Still, at $184 compared to a market price of $227, Apple stock looks slightly overvalued. While the present value of all of the free cash flow I expect Amazon will generate is over $2.6 trillion. I'm forecasting a significantly higher growth rate for Amazon compared to Apple, and the intrinsic value per share I calculated for Amazon is over $251 compared to a market price of $229. So according to my proprietary valuation framework, Amazon stock looks undervalued. By the way, these charts that I shared with you in this video, including this one with the forward price to earnings ratio, I'm getting from fiscal.ai, which is my preferred data provider. There's a link in the description for their services. You get a discount for using my affiliate link. Now, comparing these two on valuation, Amazon stock is slightly more expensive, about 10% more expensive on a forward PE basis at a forward PE of 33 compared to a forward PE of 30 for Apple. But I believe that Amazon deserves this better valuation on forward price to earnings because it's generating much better revenue growth, nearly 3 times the revenue growth of Apple in the previous decade, and better growth prospects looking ahead. Also, it's improving its operating cash flow to sales ratio and other profitability metrics, while Apple's profitability metrics are going in the opposite direction. So I feel comfortable paying this premium for Amazon. So if I had to pick one of these two tech giants to buy today, I would pick Amazon, and it would be a relatively easy decision in this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.